Hi everyone, welcome back to the US CPA classes for financial accounting and reporting. In this video, which is part 2 of investment, I'll be covering in detail about equity security, which include cost method, fair value method or equity method of investment. All these category of method of investment we'll be covering in this video, which is part 2 of investment. Please go through part 1 if you have not seen, because it is in continuation of the same. So let's dive into to finish off the topic investment as per US GAAP.
Hi everyone, welcome to the FAR class. Today we'll be continuing with the topic of investment. So if you remember in last class we started first with 4.5, which is foreign currency transaction and translation. There we covered overview, definition, foreign currency transaction, foreign currency financial instrument, hedge transaction and foreign currency translation hedge. After that we did certain example and illustration, right? And then after we started new topic which is called investment. In investment, in last week we have covered debt security. In the debt security we covered three things: held till maturity, trading security and available for debt security. Now today we'll be covering investment in equity. Investment in equity security will be covering cost method, fair value method, investment in equity method, and then like there is one more topic, subsidiary or consolidation method, that is covered in chapter 1. So today we'll be covering cost method of equity investment, fair value method of equity investment or equity method of investment. So generally cost method and fair value method is being used when you have made the investment in any company's equity for less than 20%. Whereas equity method of investment is being used when you have invested more than 20% but less than 50%. Subsidiary and consolidation method is being used when you have invested more than 50%. So right, so these are the thumb rule, you can say, but there are certain exception to this thumb rule or general rule. So we'll be discussing one by one that also, but high level, why 0 to 20%? Any idea? Do we consider for cost method or fair value method?
Sir, because 0 to 20% it's basically it's just investment, not that we are making any decisions of the company or participating in the business of the company. So investment को value करने के लिए it's cost method or fair value method.
Yeah, very true. So because like as a general rule, we consider if we are investing in any company for less than 10%, you may not have stake in policy making, you may not have stake in operational activity, you may not have stake in any financing activity, or you may not have any significant influence on the operation and finance part of that company, right? So that is the reason it has to be measured either at cost or at fair value. But there are certain exceptions to this general rule that also we'll be discussing. Second is equity method investment. So when you have invested more than 20% but less than 50%. So why equity method investment is required when you have investment 20 to 50%? Any idea? Have you heard this term before, equity method investment?
Yes, sir. Yes, sir.
Any idea what is that?
So basically, sir, इसमें what happens is that if we have stake like 20 to 50%, then it is believed that we are controlling earning profit from that portion of the business, 20 to 50%. So that portion we are consolidating in our accounts, like 50% of the business we will consolidate, like profits we will recognize 50%, assets we will recognize 50%, something like this. I remember this only.
Anyone else? Gurmehar, Kashish?
The percentage would be high ना, तो उसमें शेयर होल्डिंग भी है, वो भी ज्यादा ही रहेगी, तो जो पावर है मतलब जो भी कॉस्टिंग वगैरह भी है सर, एंड जो प्रॉफिट जो भी अर्न होगा वो भी ज्यादा ही होगा. शेयर होल्डिंग ज्यादा तो सर ऑब्वियसली सर वो कहीं ना कहीं इम्पैक्ट तो करेगा ही।
Gurmeher?
I believe because percentage ज़्यादा है तो you have a more influence, like you are
Mm-hmm.
into their decision making. You have more influence basically.
Mm-hmm.
You're into their decision making.
Mm-hmm.
Like the key positions, right? So अगर तुम stake तुम्हारा 20 से 30-50% एक कंपनी में है,
Mm-hmm.
so you are a part of the decision making process.
Mm-hmm.
That's why we believe mention it as in equity in method investments.
Yeah, no, very true. So, when you have when you invested in any company for more than 20% or less than 50%, it's a general perception that you have significant influence in that company because you are holding more than 20% equity share. That means more than 1/5 of the equity share, right? If you are holding more than 20% equity share, that means you may have position in the board of directors, right? You may have position in policy making for the company, whether any operating policy or financing policy. Because like any company who has like any particular shareholder who is like more than 20% share owner, so they would be like sharing all the MIS, the decision taking, or they might be taking internal approval, or you can say acceptance from that particular individual for for any significant decision they are taking for the business, right? That is the reason it is considered that the person who is holding more than 20% equity share may have significant influence in that particular company. So as you have significant influence in that particular company, so then you need to follow equity method of investment. So how to follow equity method of investment? Akash, Ayush, what you said is like more or less in the same line. But why is being because you have more than 20% equity and you have significant influence in the operation and financial policies of that particular company. Make sense?
Yes, sir.
तो
Yes,
यस
sir.
सर।
Third one is more than 50%. So when you have more than 50% equity share in any particular company, then you are required to do the consolidation. Consolidation means adding their assets into your assets, adding their liability into your liability, and then from the equity side, identifying what is the non-controlling interest and recognizing that as a part of your financial statement in equity statement, non-controlling interest, right? So we'll be discussing about like subsidiary and consolidation more in detail in chapter 1, but in this topic majorly focus would be on less than 20% or 20 to 50% of equity investment, right? Because we are studying investment chapter topic. When we are studying consolidation topic, then we'll be discussing more in detail about subsidiary and consolidation.
फिर इसमें why do we save as non-controlling interest? Because अगर हम 50% ज़्यादा इक्विटी हमारे पास है किसी कंपनी की, फिर भी why do we say it like non-controlling interest? कंट्रोल तो है।
I think you heard it wrong. I said like when you are doing consolidation, so at that point of time, I'll show you maybe a small example really. So I think in this example, hope you remember this example, right? Let's assume in this subsidiary India B, in this company you are holding, let's say, 80% equity. 80% equity is held by one second, sorry. Where is parent company? You wish to add parent company in this example? Okay, so let's assume this is parent company. This is, let's say, parent company, and this is their financial. And this is subsidiary C in Russia, where you hold 80% equity. Now, if you see here, what all thing? Sorry, for this company in equity, how much percentage you have? 80%. That means 20% is with someone else. Yeah, 𝐒𝐿.
Yes, sir.
And when you are doing consolidation, here you have shown 212,500, right? Whereas it will come this. Sorry, this is a parent company. Here, let's say you hold 100%. Sorry, this is your parent company. This is your subsidiary where you hold 100%. This is your subsidiary where you hold 80%. And this is your JV where you hold 50%. Right now, coming to consolidated financial statement, when you are making consolidated financial statement, in the consolidated financial statement, you have the cash and bank total, you have AR, inventory, investment, property, plant and equipment. So this is your total assets. Whereas in liability, you have this payable, accrued liability, provision, debt. But whereas in equity, you will be having two things. One is non-controlling interest, and second is equity. So what is your non-controlling interest? First, you need to identify that. Your non-controlling interest is 800. And you have also 50% non-controlling interest here. So this is your total non-controlling interest. That means you are not owner of this much amount, right? So how much amount you are owner? Right? So this way you need to show non-controlling interest,
Oh, okay. Got it.
for which you are not owner of the subsidiaries.
Okay.
Okay, so let's understand first method, which is cost method. When you have less than 20% equity, and those equity are, you can say, in which you have invested, are in a private company or in a company which is not listed on any stock exchange, or for which fair value is not available, right? So this method is used to the non-marketable security. What is non-marketable security? The company whose shares are not available in the general market or not traded in the general market. Make sense?
Yes, sir.
Yes, sir.
Second important thing is the investment which you have made is not for a trading. It is a long-term investment, right? When you can use cost method, when you are making investment for long-term period. If you are making investment for sale, then it is your trading investment. Make sense? And trading is always being valued at fair value. Make sense?
Yes, sir.
Third is use the cost method or lower of cost or market if other than temporary decline in the value below the cost. So have you heard about like impairment?
Yes, sir.
Any idea what is impairment?
Sir, impairment is basically when the market value of a particular asset reduces below its cost. Then we need to impair it in our books and recognize the value at the fair value of the as prevailing in the market.
Permanently decrease हो गई value. That is impairment.
Yeah, very true. So in case of investment, in case of investment, there may be possibility like the price will go up. There may be a possibility the price may go down. But if there is a permanent decline, which cannot go up based on the best of your estimate, then you need to recognize that loss. But if there is temporary up and down, if you see in share market every day there is an up and down, and every moment and every second there is some up and down, right? Same way for the valuation of any company, it may sometime go up, it may sometime go down, right? So you should not be worried about these temporary ups and downs. But if you see there is a reason to believe that the downsize would be permanent, then you need to book the impairment loss. What is downsize permanent? For example, there is a company, let's say there is any like C corporation or S corporation, which is not a listed company, right? And they are into, let's say, the business of like manufacturing plastic product, and all of a sudden government has come up with a new law and they have banned their product, right? If that plastic product is being banned and they do not have alternate capacity to utilize the plant for any other purpose, then it is a permanent decline into their business, right? Yes, no?
Yes.
So then it should be considered as an impairment loss of the investment also. But like the raw material price, polyethylene, polypropylene, go up and down based on the petroleum price, and that impact their pricing. So would that impact the valuation? The answer is no, because those ups and downs are temporary. Make sense?
Yes.
Gurmehar, Kashish?
Yes, sir. Yes, sir.
Yes, sir.
Last one is lack of significant influence. Because you have less than 20% equity share, you do not have, it is considered that you do not have significant influence in operation and financing activities or policy of the company. So in that case of scenario, you would be considering the valuation of investment at a cost method. Any doubt? What is cost method and when we need to use the cost method?
No, sir.
Now coming to the second point, which is fair value method. Same thing, 0 to 20% investment, but when this investment is in marketable security, that means security which is being traded in any stock exchange. That means, for example, if you have purchased the stock of Procter and Gamble, if you have purchased the stock of Hyundai, right? So those are available in the market security, right? So in that case of scenario, you have like readily available market price of those investment through the stock exchange, respective stock exchange, right? Again, second important thing is, but it lack significant influence. If the significant influence will be there, then you will be using equity method of investment. And if you are holding more than 50%, then you are using consolidation method. right? If investment increase more than 20%, for example, initially you have invested 5%, then you purchase another 10%, total is 15%, then you purchase another 10%. Now your total investment is 25%, which is more than 20%. Then you need to switch to the equity method of investment. Make sense?
Yes, sir.
Yeah. So you'll see some question in which probably in January, like let me illustrate you an example. Mr. Or you can say company A was holding 15% equity share on 1st January 2022 in company B, and on March 31st 2022 company A acquired additional 10% equity share of company B. Right, in that case of scenario, till 31st March you would be considering either to use cost method or the fair value method. But the day you have acquired more than 20% equity share, from that day onward, you need to apply equity method of investment. That is called switching. Make sense?
Yes,
Yes.
sir.
एक बार ही repeat करना है last time जो
Yes, just read this point again. If investment increase more than 20%, that means, for example, on 1st January, you have company A has invested 15% in company B, and on, let's say, February 28th, company A has invested additional 10% in company B. That means on 28th February, you are holder of 25% equity share, right?
yes sir yes sir
So as you are holding more than 20%, you will be considered as to follow equity method of investment,
yes sir
right? So till 28th of February, you might be using cost method or maybe fair value method. But from 1st March, when you are acquired more than 20% stake, then onward you will be following equity method of investment. Make sense?
yes sir got it
All trading security should be valued at fair value, right? This is thumb rule. Yes, no. All trading security should be valued at fair value, whether it is more or less than 20%. Last one is any change in fair value need to be recognized in income statement, right? So any doubt on equity method or fair value method?
No, sir.
How do we identify fair value?
Investment is more than 20%.
No. My question is, how do we identify the fair value?
Okay. Uh, as per the market price, what the price at which securities are being traded in the market should be the market fair value.
Yes, absolutely right. As this security are being traded in the security exchange, so whatever is the pricing on the particular date of that particular equity, that is being considered as the fair value, minus if there is any, you can say, transaction cost involved. So like for example, commission to the security exchange or maybe some broker fees that need to be reduced, right? So first is cost method, second is fair value method. Now we are jumping onto the third one, which is equity method investment. So equity method investment, when you have 20 to 50% stake, that means you have significant influence. Significant influence mean you can influence the operating policies or financing policy of an organization because you are in board of director, right? Or you might be in a position of the key management person, right? So you are in a position to impact the operating and financing policy of the organization. Hence, it is considered as a significant influence. Second is initially, like how do you record equity method of investment? Initially, it is recorded at cost. And what is cost? Your purchase price at which you have purchased, plus if you have paid any brokerage or commission, plus or minus if there is any income or loss share in the investee, right? Minus if there is any dividend received in proportionate to the investment share. That is the closing book value of the investment. How do you calculate the cost of investment? The purchase price you have paid plus any brokerage or commission you have paid minus if there is any loss, add if there is any income, minus if you have already received any dividend, will result into the cost of investment. Initially, you need to record at cost, right? Then after, when you are doing consolidation, so you'll do the equity method investment this way. So you'll be taking, let's say, this company Taiwan is, let's say, have 25%. Let's say in this you have 25% equity. So then this into 0.25. This is what you will be adding. Only your share. Right? Are you guys with me?
Yes, sir.
Yes, sir.
So, for example, if this Taiwan JV, in that you have only 25% equity, then in that case of scenario, you will not be adding full assets or full liability. You will be adding only your percentage of assets and your percentage of liability. Nothing to do with non-controlling interest also. So with equity, you will not be changing anything. Make sense?
Yes, sir.
Sir, if it is more than 50%, then it will be
Then
like
it's a consolidation,
okay.
right? Additional consideration. What all additional things you need to keep in mind? First is investors' ownership percentage is based on the voting stock, whether common or preferred. However, investor share of the investee earning or loss is based on common stock. So general rule is the investee share is based on common stock. But there are certain situations in which you will be having voting right even though you are having preference share. So that also you need to consider, have we given any voting right to the preference share or debenture or to the bonds or any other person. Second is if investment value reduced to zero. If your investment value has reduced to zero, then no equity method is required because the valuation is already zero. For example, if you have made an investment in any company in Ukraine, and now in Ukraine and Russia war, that company has got destroyed, then the value of investment is zero. Why? You need to keep into your books of accounts. It has to be impaired, right? Make sense?
Yes, sir.
Yes, sir.
Third is if investment decrease below 20%, investors should switch to fair value method. For example, on 1st January 2022, A company has an investment of 25% in B company. On, let's say, on 30th April 2022, the company A has sold 10% equity of company B. That means now you have only 15% equity, right?
Right.
Yes, sir.
So you need to switch from equity method to fair value method or cost method as the case may be. Make sense?
Yes, sir. Clear.
Last one is equity method investment is also allowed to elect fair value option. That means you can choose cost method or fair value method as the case may be. Right? Any doubt? cost method, fair value method, equity method of investment?
No, sir, all good.
All good? Ashish?
हाँ जी सर क्लियर है
Okay. So now let's understand few more concepts. Ability to exercise significant influence. So we have discussed earlier also, when you have more than 20% equity share or less than 50% equity share or voting right, then you are in a position to significantly influence that particular company, right? When investor has ability to exercise significant influence over operating policy or financial policy, right? So there is a general rule. General rule says less than 20% of the voting stock does not have ability to significant influence. This is what we have studied in first and second cost method or fair value method. What, right? Cost method and fair value method we have studied. These people have less than 20% equity share, hence they do not have any influence in the operating and financing activities or the policies. That
So
is
what
what
if what if a person is like, मैं वैसे सोच रहा हूँ ऑडिट के जो मैंने पढ़ा था, what if a person is at such a position कि वो CEO है या CFO है या मतलब चीफ ऑपरेशंस है, बट शेयर्स उसके पास 15% है पर्टिकुलर कंपनी के,
yeah.
तो
So
उस
that
सेंस
comes,
में तो वो डिसीजन मेकिंग पावर उसका फिर भी है ना.
yes, yes. So now if you see exception to the general, so what we have studied so far is a general rule, but where there is a general rule, there is an exception to the general rule. So exception to the general rule, certain general rules, examples that may indicate the investor has ability to exercise the significant influence over the investee even though it owned less than 20% stock. Right? Exactly your point, Gurmeet. Even though the person is having less than 20% stake, but still it can be considered as a significant influential person.
Oh, yeah.
First one is the investee is being part of board of directors. That means he or she is being involved in the decision making process and policy making process, and it has influence in taking the respective decision. Second is participation in investee policy, like policy making में participation. Third is material intercompany transaction with the investee. For example, let's say let's say Gurmeher has opened an offshore center in Canada, right? And let's assume 𝐒𝐶 has made 10% investment in that company. And now Gurmeher is doing all the marketing and business development activity, and all the work is being offloaded to 𝐒𝐶. That means, let's say 80% of the business of Gurmeher is being executed by the 𝐒𝐶, even though 𝐒𝐶 has 10% equity share in that business. But if you see the volume of transaction which we are doing day in, day out together, it shows that material intercompany transaction, we both are intercompany because let's say 𝐒𝐶 has made 10% investment, so we are in intercompany, right? And 80% of the Gurmeher business is being executed by 𝐒𝐶. Then you cannot say I do not have significant influence, right? Make sense?
Yes.
Next one is interchange the managerial person. That means the person, the investor, has the capabilities or the right in his hand that he can change the key managerial person. That means he can remove the CEO and appoint some other CEO. He can remove CFO and appoint some other CFO, right? So then that person is considered into the significant influence. Make sense?
Yes, sir.
For example, if you see nowadays in the startup era, right, there are many people who do the as a who work as a mentor for the startup, and they take like 2 to 5% or 5 to 10% equity in that startup for providing their guidance. But if you see, they have significant influence, because the person who is doing startup is very much dependent on that mentor advice, and the mentor advice matter the most for that individual, right? Even though that person have less than 5% equity share, but being a mentor of that startup, is in a position to have a significant influence in decision taking of that startup. Make sense? Yes, no.
Yes,
Yes,
sir.
sir. Clear है पूरा.
Next one is technologically dependency of investee on investor. For example, if you have open a subsidiary in, let's say, Nigeria for Coca-Cola, right, and you have made certain investment, and Coca-Cola has invested, let's say, 10% into your company, but you cannot make Coca-Cola in your company without having the formula of Coca-Cola, right? So patent technology sometimes. For example, if you have set up a new plant for, let's say, MRF tires, right, and you have made the entire investment, and you have had a patenting agreement with MRF, that means they will give you the design and bill of material and composition for manufacturing of the tire, right, and you will be producing the tires only and only for MRF. So in that case of scenario, you are a job worker of MRF, and you cannot use any other company's products. So in that case of scenario, even though MRF may not have any investment in your company, but you are just a job worker, but they are in a position to influence your overall business, right? So then also it is considered as a significant influence. Make sense? Yes, no?
Yes, sir.
Right. Next is another side, another angle of it. First angle we have seen, when you have less than 20% equity, but exception to that general rule is you can consider yourself as a significant influential despite of having less than 20% shares. Now coming to the flip side, other side. When you have 20 to 50% equity share, but still you will not consider as significant influential. General rule is when you have 20 to 50% equity, you will be considered to have a significant influence in that company. Yes, this is what we have studied.
Yes, sir.
Yes, sir.
But there is an exception to this general rule. Despite of the fact you have more than 20% equity share or less than 50% equity share, but still you will not be considered as having any significant influence. So example of possible situation that investor may not have significant influence even it hold 20 to 50% voting stock. First one is when investor surrender significant right under an agreement. That means non-voting right. So have you heard about non-voting shareholders?
Yes, sir.
Right?
Yes, sir.
What are non-voting shareholders? They are having equity. They avail all the benefit of the equity, but they have no right to vote. That means they cannot influence the policy making of the organization. Right? Second is investors' legal inability to exercise the significant influence. That means the person who has made an investment in that particular company may be a minor, right? Or maybe somebody has got the share of any particular company because of the death of the father or grandfather, but that person is of insane mind, right? So in that case of scenario also, that person would not consider to have any significant influence. Make sense?
Yes, sir.
Third one is investors tries and fail to obtain representation on the investee's board of director. That means when investor try to get himself or herself to be the member of board of director, but other shareholder has refused, and that person cannot become the board of director. So if you are not do not have any representation in board, that means you are not part of influential, right? Next is majority ownership of investee is concentrated among the small group of shareholders. That means you have 25% shares, but I have 75% share, and I'm not allowing you to participate in decision taking. Right? In that case of scenario, despite of the fact you have more than 20% equity share, but you cannot force your decision for any financial matter or operational matter of the company. Last one is investors try. Sorry, second last is majority ownership of the investor. Last one is investor tries and fail to obtain additional information required to apply the equity method. In all those scenarios, even though if you have more than 20% equity, but you will still not consider to have any significant influence. Make sense?
Yes, sir.
Yes, sir.
Ashish, Gurmeher? Okay, so we
Yes, sir.
understood what is ability to exercise significant influence, what are the general rules, and what are the exception to those general rules. Right, now let's do some practice question. Doll company has 25% interest in the common stock of Patel, and an and an 18% interest in the common stock of Joe. So Doll company has 25% interest in Patel and 18% interest in the job. Neither investment gave Doll the ability to exercise significant influence over the company operating and financial policy. Which of the two investments should Doll account for using equity method? So what is the call of the question? Which of the company Doll should consider for equity method of investment? So what do you consider to identify equity method of investment to be applied or not?
Sir, if it is more than 50% stake.
No.
Sir, 20 to 50% stake.
20 to 50% is
20 to
general rule,
50%.
but more important is significant influence. So in this two company, does the doll have significant influence or not?
No, sir.
Why not?
Because it
You
is
mentioned, है
mentioned
ना?
he does not have the ability to influence.
Neither investment give doll the ability to exercise significant influence over either the company's operating or financial
अच्छा
policy.
ये एक्सेप्शन हो गई बेसिकली इसलिए
Yes.
करेक्ट
Right?
Okay,
So
okay,
hence
got
the
it, sir.
answer is neither Patel nor Paul.
सर वैसे
Yes.
तो 20 to 50% होता ना,
Yes.
तो सर 18% तो वैसे ही सर हट गया वो वाला तो
So the
25 वाला जो है उसमें
Joe
वैसे ही
company was already out of the scope
हाँ
as per general rule, but 25% interest in Patel company shows yes there may be a significant influence. But when it is clearly mentioned that you do not have significant influence, then you can consider either at cost method or fair value method.
वो तो सर फिर फायदा ही नहीं होता.
No, I can't say like this. It's an investment,
हाँ
right? Okay, let's come to the next question. In 2001, S Corporation acquired 6,000 share of its $1 par value common stock at 36 per share. During 2002, S issued 3,000 of these shares at 50 per share. S used the cost method to account for the treasury stock transaction. What account and amount should S credit in 2002 to record the issuance of 3,000? You know what is treasury stock? Any idea what is treasury stock? We discussed in very first class along with definition. Anji, any
Sir,
idea what is treasury stock?
सर जो आउटस्टैंडिंग शेयर्स थे पहले हमारे उनको हमने रीपरचेज कर लेते हैं अगर हम मार्केट से
Yeah,
दैट
same way how in India we call buyback,
बायबैक ऑफ शेयर्स राइट
right?
Issued, authorized but not issued. Basically हमने
No,
issue
no, you
करके
have
वापसी buyback कर लिया.
वर
yes,
इशूड एंड बॉट बैक
Got
yes,
back.
yes,
हाँ.
yes, right? So here S Corporation acquired 6,000 share of one par value at 36. So original issue किया था उन्होंने $36 per share for 6,000 share. In 2002, 3,000 of these share at 50 per share they have done buyback. And S used cost method to account for the treasury transaction. What account and amount should S credit? So first one is treasury stock 144,000 and retained earnings 6,000. Second is treasury stock 108, common stock 42. Third is treasury stock 102, additional paid in capital 42 and retained earnings 6,000. Fourth is treasury stock 108, additional paid in capital. Let's do the math for it. What is the call of the question? 6,000 share. Yes, value 6,000, $1 each, right? Are you guys with me?
यस सर
Yes, sir.
Yes, sir.
Right. And shares have been issued at 36. Right. That will go in additional paid in capital. For how much? $35. Originally they have issued at 36. So 35 will be this will be your additional paid in capital. This one is 2001, 2001. Now in 2002, they want to buy back treasury share. How much? 3,000.
राइट 3000 at 50 so 3,000 is to 1
And plus $50 minus
36
अरे इशू करे हैं या फिर एक्वायर करे हैं?
acquire.
एक्वायर तो 6,000 करे हैं ना?
हाँ 6,000 एक्वायर करे और उसके बाद
3 फिर री इशू करे.
3,000
Okay.
3 को
One
रीइश्यू
once
करा ना
again.
सर.
In 2001, S Corporation acquired 6,000 share of its one par value of common stock at 36. In 2002, S issued 3,000 of these shares. Okay, S issued 3,000 of these shares at 50 per share. S use cost method to account for the treasury transaction. Okay, what amount should S credit in 2002 to record the issuance of 3000 share? So this out of this 6000 share, this is your treasury stock. This is your treasury stock, and out of this treasury share issue, right? This is what they are doing.
At 50 per share. So it would be
As at 50%. So this is 50, right? Right. So this will go to so your treasury stock is 102. Why it is 102? This is when you are getting additional paid-in capital, and this is your treasury stock. So what account and amount should S credit in 2002 to record the issuance of 3000 share? Retained earning should be 3000, right? Retained earning should be 3000, right? And this treasury stock should be 105, right? Akash, Ayush,
Yes, sir.
right? So if you see, like out of this was the treasury stock, right?
Yes.
In that they have face value
Brother.
and the retained or additional paid-in capital. So
Right.
now out of this 3000 they have issued. So 3000 which they have issued, this entry they might have made retain earning, right? So it has to go back to the from the retain earning. But this is this should be from like treasury stock.
सर ये रिटेन अर्निंग आप कैसे लिख रहे हो? मेरे को वो बस क्लैरिटी नहीं आ रही है एक बार, क्योंकि रिटेन अर्निंग जो होगा वो तो हमारा शेयर इशू करने के बाद जो बच रहा है वही होगा ना पैसा, प्रॉफिट्स में सब कुछ सेट ऑफ करने के बाद.
No, when you do buyback of share, what is the journal entry you make?
Buyback.
So you use the
Yeah,
retained earning to buy back that share now.
correct.
Equity to RE, generally ये entry pass कर देना.
Yes.
Right, so I'm just reversing that entry.
Okay.
Right, so this 3000 will go to retain earning, and this will release from treasury stock. So it has to be this number. Right, was like this amount go to the This will go to the retained earning and this will go to the
Yes.
treasury stock. Or this go to the right. So ideally it should be 105. Additional paid in capital is good. Retained earnings should be 3,000. So this should be the answer. Right? Clear?
हाँ सर, एक बार सर वो दिखाना जो आपने करा हुआ है, एक बार शीट
Huh.
में.
So here, like 3,000 is the treasury stock that will come out from the retained earning,
Correct.
right? And this will be the reversal of additional paid in capital.
हाँ जी. राइट, ट्रेजरी स्टॉक में से जो निकल गया अमाउंट 1,05,000 का.
Right?
हाँ.
So this is how, like the original entry you might have been made. So you are reversing that.
हाँ, तो आरी डेबिट हो गया 3,000 आरी बच गया, और 2,10 में से आपका 1,5 हो गया, तो $1,05,000 वो बच गया ट्रेजरी स्टॉक, और स्टॉक 42,000 ही हो गया. करेक्ट.
So this is new additional paid in capital, because like in US share premium we call it additional paid in capital. Right? So $36 per share you have paid and which you have issued for $50 per share. So this $14 per share is security premium or share premium in US, which is called addition paid in capital.
Okay.
Right? Kashish, Gurmeher?
Yes, sir.
Okay, next question. What factor would not be an indicator of investors' ability to exercise significant influence over the financial and operating policy of an investee? What factor would not be an indicator? All of the question is, would not be an indicator of investor ability to exercise significant influence. Investor representation on the investee board of director, that is an indicator that he or she has influence, right? Second is
Yes, sir.
dependency by investee on investors' proprietary technology, like we discussed Coca-Cola example, MRF example, right? Third is interchange of managerial person between investor and investee. That means my CFO can be your CFO, your CEO can be my CEO. That means we can exchange the top management person. That means we have influence over each other. Last one is investor recommendation for the investee to hire specific executive. It is just a recommendation, right? It does not show influence. Make sense? Why fourth answer is correct?
Yes, sir.
Yes, sir. Clear.
What is the call of the question?
Sir, call is ki
That would not be considered as investor
significant
ability.
influence. Which of the following would not be considered an investor's ability to exercise significant influence?
So, like if investor is recommending any key managerial person, would it be considered as significant influence?
नहीं सर, क्योंकि सर वो recommendation दे रहा है, कोई ऐसा कोई
Yeah,
वो नहीं
it's
है.
just a recommendation. Then company will do their own evaluation process, right? Your HR round, technical round, and all those interviews will go on, right?
Right.
Yes, sir.
Yes, sir.
Okay, so miscellaneous topic. Or shall we take a break over here?
Sir,
Then we start on miscellaneous topic.
yes, sir.
Sure, sir.
Okay, so it's 11:15. Let's come back at how much time? 20 minutes, 30 minutes?
इससे 30 तो ज्यादा हो जाएगा, सो ही जाएंगे।
20 minutes?
25 minutes।
ठीक है, so it's 11:17. So let's come back at 11:40.
ठीक है सर, डन।
ठीक है
ओके।